There's almost nothing more stressful you can do with your money than trying to invest it in a volatile market. Even though things move around quite a bit normally, when volatility becomes really pronounced, it can really make it hard to make a day-to-day decision. Today we're going to talk about ways you can continue to invest your money during times of volatility without having to think too hard about it. It's called dollar cost averaging, and I'm going to explain to you how it works. Before we get started, I want to remind you that I'm not a financial advisor, and because everyone's personal financial situation is different, this isn't personalized financial advice. Right now, it might feel hard to remember that the stock market has traditionally gone up over time. That doesn't mean it goes up every day. Last year, in 2021, stocks hit all-time highs. This year, in 2022, they've been consistently going down. And no one knows where the bottom is. The historical average return of the stock market is about 10%. But trust me, people have not always felt like it's doing that even when it has. Between 1926 and 2022, returns were between this band of 8 and 12% only 7 times. The rest of the time, they were either lower or usually much higher. Volatility is something people deal with even in the best of times in the stock market. Now, there's no guarantee that the stock market's going to repeat its past performance if you invest in it now, even over time. But it is important to remember that if you leave your money somewhere with a lower return, like maybe a checking account, you're going to be vulnerable to inflation. Dollar cost averaging refers to just buying or selling something on a set schedule, regardless of what the market does. Here's an example. If you bought into the S&P 500 at the beginning of 2022, your investment on June 1st would be down about 14.5% for the year. If you invested once a month, on the other hand, say on the 1st, you would have been buying in as prices declined. So your average price would be lower, and your investment would have lost only about 7%. You invested the same amount of money in the same thing over the same period of time, and you cut your loss in half. This is the magic of dollar cost averaging. Dollar cost averaging can be particularly helpful in times when the market is going down. Maybe you'd sit it out for a while because you weren't sure what the market is going to do, but if you put in a little bit, you can actually get a discount, right? You're buying something that you hope will go up, and you're getting it at a cheaper price than you'd otherwise get it. And if you really think about it, you're already dollar cost averaging if you have a 401k or another kind of retirement account. If the market goes down, you don't suddenly stop funding your 401k because you still want to retire. This can also apply to other kinds of personal investments. So if you think the market's going to go up over time, if you want to do something with your money rather than leaving it in a banking account, then you might want to consider dollar cost averaging as a way to continue gaining exposure to equities or other investments that might grow over time. Now let's walk through some scenarios that include buying and selling. Here's a set of examples that come from one of NerdWallet's in-depth articles. The first one is going to be a lump sum purchase. This will be our baseline. With a $10,000 lump sum purchase of a stock at $50, that nets you 200 shares. Let's see what happens when you sell it at certain prices. If you sell it at $40, you're going to lose $2,000. If you sell it at $60, you're going to gain $2,000. If you sell it at $80, all of it that is, you're going to get $6,000. Now, in a falling market, this is where you can really see dollar cost averaging strength. Let's assume that the $10,000 was going to be split equally among 4 purchases at the prices of $40, $50, $30, and $25 over the course of a year. Those 4 $2,500 will buy a total of 295.8 shares, a substantial increase over the lump sum purchase. Let's look at the profit at those same sell prices again. So if you sell it at $40, you're going to lose $1,832. If you sell it at $60, you're going to gain $7,748. If you sell it at $80, you're going to gain $13,664. With dollar cost averaging, you actually have an overall gain at $40 per share of stock. In a flattish market, it's a little more complicated how dollar cost averaging will perform. Let's assume that $10,000 is split equally among 4 purchases at prices of $50, $40, $60, and $55 over the course of a year. Those 4 purchases will get 199.6 shares, basically what a lump sum purchase would get. The scenario looks equivalent to the lump sum purchase, but it really isn't, because if you've eliminated the risk of mistiming the market at a minimal cost. And here's a fourth scenario, in a rising market. In this final scenario, let's assume that the same $10,000 is split into 4 installments at prices of $50, $65, $70, and $80 as the market rises. These purchases would net you 155.4 shares. Here's the payoff profile. $40 sale would lose you about $3,782. $60 sale would lose you about $676, and $80 sale would gain you about $2,432. This is the one scenario where dollar cost averaging appears weak, at least in the short term. Dollar cost averaging is not perfect. If the market's rising, your upside could be limited by dollar cost averaging in the same way that your downside can be limited by dollar cost averaging. For instance, if the market goes up and you buy at the very bottom and you sell at the top, you're going to do better than if you bought all the way up. However, it's not always clear in the moment what's happening. So if you really think you can time the market, maybe you want to try to play a little bit more. Some people try to time the market on a daily basis. Day traders, they want to buy a stock and then sell it a couple hours later once the price has gone up a little bit and hope it doesn't go down. And some people have made money doing this. A lot of people have lost money, and even people who get lucky aren't always good. When you're investing in the stock market, another way to think about it is as a long-term strategy. Not money you're going to need right away, not money that you're going to miss right away. Think about it this way. Maybe dollar cost averaging is like buying a house. You pay the mortgage, you take in some of the equity as you buy more into it, and the value may grow over time. Maybe day trading is a little bit more like flipping a house. You're not intending to stay there for long, but you hope to get something economically out of it while you're there. Okay, look, the economy is stressful right now. Dollar cost averaging can basically let you take a break. You don't even have to look at it. A lot of brokers and other online services will automate this for you. They'll take something out of your paycheck once a week and say you have $50 you can afford to invest every week. It comes out without you having to decide, without you having to think, without you having to adjust your decision on a week-to-week basis. You don't even have to look at it. You might want to just come back next year or the year after or whenever you feel the market's improved and see how you did. And in this market, it would be understandable if your financial situation has changed. Maybe you won't be able to invest as much because something about your financial life needs attention more than long-term investing. That's totally fine. If you're investing because you feel you have money that you can spare, that's one thing. If you're going to stop investing not because of your financial situation, but because you're worried about the market, that's not dollar cost averaging. Dollar cost averaging is about long-term investing. Essentially, money that you're going to put in the stock market, you're going to want to leave it there, maybe say for at least 5 years and then look back at it. Again, this is about trying to keep pace with the growth of the overall economy. It's about trying to keep pace with inflation. Things, as we all know, cost more now than they did even a couple months ago. Now, if you leave your money somewhere where it doesn't grow, it's not going to keep up. Hopefully, if you do well with your investments and use dollar cost averaging, money can grow and be even more than it would have been otherwise. Ultimately, dollar cost averaging is about trying to smooth out your purchase price over time. You're not trying to buy at the top of the market. You're not trying to buy at the bottom. You're not really even trying to figure out which is which. But if you do dollar cost averaging correctly, it really can benefit your portfolio. I'm Andy Rosen, an investing writer for NerdWallet. For my own mental health, I have not looked at my retirement account for months, and that's okay. But if you learned something today, please like and subscribe.